Welcome back, homies, and buckle up because it's time for part 2. And this episode is a masterclass in the lending secrets that 99% of the real estate industry never tell you about. This is the second half of my conversation with unicorn lender Kelly Cort. We're going to go deep into a whole bunch of topics like down payment assistance programs. How do those really work? Who qualifies for them? Yeah, even folks with 20% down can qualify. And get this, how you can stack them using multiple different programs for maximum benefits. And we talk about how the right team can turn a maybe in 2 or 3 years dream into a closed in 3 months reality. This is everything that a clickbait ad for a 5.5% interest rate won't tell you. You're going to find out why choosing your lender based on actual guidance and service, not a website quote of an interest rate, is the difference between approved and winning the house. Let's do it. Because I got you here and because the homies want to know everything about buying a home, you know what? Let me jump ahead to what about down payment assistance programs? What have you seen being used? Because we just got into all the crazy minutiae with all those people. What about the people who are sitting there going, dude, I'm nowhere near 20%.
Yeah.
What do you tell them?
Yeah. So very cool. We love down payment assistance programs. I've worked for a few different lenders and I've been here at Guild for several years now, and I've never seen anybody do down payment assistance better than we do. Now, that was my little commercial, but I will say it's so easy to know, one, do you qualify for down payment assistance? Here's a high quality problem. Some people make too much money to qualify. So most of these down payment assistance programs require you to make 80% or less of the area median income. And you can look up, it's usually based on county or township, what the area median income is. You can look it up in the area that you're interested in buying. They'll tell you what the area median income. Take 80% of that. And if you make less than 80% of the area median income, you're usually going to qualify for some down payment assistance. Now, down payment assistance is funded by local outreach efforts or reinvestment acts. And that's a whole other podcast on itself, David. We won't go into how they're funded, but the point I'm trying to make is that there isn't always funds available for every single down payment assistance program out there. Sometimes they run out of money.
Yeah.
Either that one of their funding sources dries up or they've had so many takers that their budget for the year is used up. So, but we have the ability to vet that for you. You don't have to figure that out, homies. Like we've got all of the down payment assistance programs in every single state except for New York. We're not licensed in New York, but every other state across the country, we have access to the down payment assistance programs. Sometimes there's some local small organizations offering down payment assistance. If it's not one we talk about in our discovery call, give me the name. We'll get it approved. We've had all kinds of tiny little programs approved along the way. So some people have 20% down and they qualify for down payment assistance.
I don't think people realize you can, and I don't think people realize you can stack them as well, right?
You can. Yeah, you can stack more than one down payment assistance program. There's like, for instance, in California, there's a down payment assistance program and a closing cost down payment assistance program you could put on top of it. So you could get your 3 or 3.5% down and then get another 1 to 1.5% on top of that for your closing costs. So it's, but you got to qualify and it doesn't come free. You guys, a lot of times these down payment assistance programs come with a higher interest rate on both the first mortgage and the down payment assistance loan. Sometimes they're grants and you never have to pay them back after making payments for 3 years. They're all different. Every single down payment assistance has a different credit score requirement, a different income limit, whether it's forgivable, meaning you don't have to pay it back after making 36 payments or something like that, or some of them require payments. It just depends on the program, how much money you make, and just who that particular down payment assistance program is targeted to. And they're different all over the country. But some people have qualified for down payment assistance and they had 20% down and they opted for the 20% down because they got a better interest rate on the first mortgage. And it also made their offer more attractive, especially in high buyer concentrated markets where there's multiple offers in these fast pit, like talk to Debbie Nissim in her market in New Jersey. Her market is moving fast. That is definitely still a seller's market. If we can get approved without down payment assistance, our offer is going to be a little more attractive. We'll be a little bit more nimble. But that said, I've said it early, my little commercial, we do down payment assistance really well. And it only adds maybe a day, sometimes not even a day, to the closing period. So a lot of these sellers want to see us close quickly, 15 days. We put everybody in position to write an offer and close in 15 days. Now, unless you're in a high fire zone or in a flood zone, that could cause a little bit longer. But insurance is really the thing that slows us down.
Yes.
But a lot of times these down payment assistance programs are so simple that it doesn't even add a day.
Wow.
And that's an education piece. So like when our clients are writing offers, we always ask our unicorn agent partners, please copy us on the offer when you send it over via email. I want to call the listing agent and make sure they understand that our buyers, our homies are underwritten already. Meaning you haven't just given me pay stubs and W-2s. I've looked at them and I've put them in front of the underwriter, who's the one who dots my I's and crosses my T's, and make sure I've done everything right so that at the end of this day, the investor is going to buy the loan.
Okay, but back that up.
Yeah.
In a competitive market, and we talked about the fact that right now there are some places where it's slowing down. If the rates drop a little bit, if people get freaked out about a potential recession, the stock market's been going up and down and up and down. If you're in a bidding war, explain how you said you actually call the listing agent.
Mm-hmm.
People, if you don't know this, there are a lot of lenders that give you a pre-approval and they don't do anything.
Mm-hmm. They say good luck.
So explain that difference in what you guys do.
Yeah. So we really work as a united team with the unicorn agent, where as you're writing your offer with your unicorn agent, we're helping. They'll call us and say, how quickly can you close? How long is it going to take you to get an appraisal? Can you do a gap? Will they qualify if the appraisal doesn't come in at their purchase price? And they've got the money. They want to make up the difference. Like, do they have that money? Yes.
Which means you might have to adjust the loan. Yes. And you might have to change the down payment. Right. Because real estate's always about two things. I say this all the time. And I was thinking it, I hope you were too, time and money. Did you hear how everything that Kelly was able to do there was change time and money? This is what the lenders that the unicorns, realtors, and when I'm working with Kelly, this is what they must and have do, because sometimes you don't have to change a lot, but if there's different options, you get a better presentation to the seller.
Right. So behind the offer, we're copied on it. And I love calling the moment that email goes out, whenever possible. If I'm not on a discovery call, I'm picking up the phone, and so is my team. We are chomping at the bit to talk to that listing agent, because we want to say, hey, we want to make sure you notice that letter is not just a pre-approval letter. It's a fully vetted, underwritten, approved, and if we need to close in 15 days, we can. And sometimes we won't say that because you don't want to close as a homie in 15 days. We're not going to reveal that if you don't want to close in 15 days. We're going to partner with you and your agent to be on your side and get you what you want as much as humanly possible. But if there's multiple offers, I'll tell the listing agent, hey, if there's something you want to see tightened up here on the loan side, let me know, because we can perform. We're ready. All we need is a contract, appraisal, preliminary title report, and insurance, and we're ready to go. Final verification of employment and a pre-closed credit report. We're done.
The bottom line is what she's saying there is usually when you get under contract, there is the bulk of the work that happens is getting the loan completed and ready to go. When you're working with a unicorn team, first of all, they've been talking to you about all the different options for months, if not a year ahead of time. And then second of all, once it gets in, they've already done all the heavy lifting. And now it's just attaching the loan to that specific property, because you've been doing it for the generic home that you're going to buy. This is why, and I was going to ask you this question, but you just told us the answer. Why should people out there, and I've been saying this forever, so this isn't Kelly doing a commercial. That's one of the reasons. What is there other reasons why you shouldn't just shop the interest rate online and then pick that person as opposed to understanding all the service.
Yeah. So a lot of online lenders aren't going to be there for you on weekends and evenings when you're trying to understand how much you can offer for this house. And they're looking at offers in the morning and they're going to make a decision. They have 2 offers in hand. You're not going to be able to get a hold of some of these lenders. Also, a lot of online lenders will show interest rates and then all of a sudden you go to ask for that interest rate and it's gone.
Yeah.
Magically it's gone. It's called bait and switch. Now, not all lenders do that. Like we don't. And I'm sure I have met so many different loan officers here at Guild over the last few years that I've been here. Nobody performs this way. That's what I call a bad actor. That's somebody who just is not clear on articulating their value. And they think the only thing that's most important is interest rate. But I'll tell you what, the lender name on that pre-approval letter that goes with your offer matters because lenders have a reputation in every single marketplace. And at the end of the day, it's still humans and it's still houses. And these humans, right? John Acuff, that's John Acuff, friend of ours that we're learning from. If a seller has had an experience with a previous buyer or maybe had an experience with a particular lender in the past, they may not want to work with that lender again. So the reputation of the lender is part of the value add when you're writing the offer. If you come in with a known online lender that, produces a letter, whether you give them pay stubs or not.
Rocket, you're not going to say it. I will.
Or others.
Or others.
Or other, call center based non-relational transactional loan officers or lenders, I should just say. Yeah. They're going to give you a letter that's not worth the paper it's on in a lot of cases because they're not even going to look at your pay stub.
Yeah. I was going to say, what about the math? So they come and they say, I can get you 6.5.
Yeah.
And you're like, hey, I've looked at everything and we're looking at a 6.65. Mm-hmm. I tell people all the time that 6.5 might end up costing you tens of thousands of more in the long run.
Yeah, because it has
give us some of the math examples of how that bait and switch will cost you.
It's anybody can quote you any rate they want. So here's the thing. Rates don't change. The thing that changes on a daily basis when the market shifts is the cost you have to pay, the points you have to pay for that particular interest rate. So you can get a 5.5% interest rate. You're just going to pay thousands and thousands of dollars for it today because it's an expensive loan today.
Yeah.
But, depending on how long you're going to stay in the home, and these are all questions we ask when you go to write your offer, you get it accepted. Okay, how long are you going to stay in this house? I know you can't answer that because no one can see the future, but what are your plans? How long do you think you're going to be in the home? Well, I'm only going to be here 3 years. Okay, then this is going to be a relatively short-term loan. Let's take a look at keeping some money in your pocket and maybe take a slightly higher interest rate with a slightly higher payment so you can keep that money in your pocket. We on the Cort team call it finding the sweet spot. We take a look at an interest rate of, let's say 6.875 with no points versus an interest rate of 6.5% with a point. 1 point is a fee, a one-time fee that you pay. And as soon as you close, that money's gone, doesn't come back to you. But you're buying a lower interest rate for 30 years for the life of the loan. Okay. And which means you're buying a lower monthly mortgage payment. But if you're not going to be in that house long enough to recoup the 1% of the loan amount in fee, if you've got a $300,000 loan, that's $3,000.
Yeah.
To buy a rate that's a quarter to a 3/8% lower in interest rate, maybe it moves your monthly payment by $20, $30 a month. It's going to take you a long time to recuperate that $3,000. Chances are you're not going to be in that home, or maybe you will be, but maybe you refinance if the rates come down. So you get rid of that loan. You won't have that loan for 30 years. So a lot of online lenders are quoting with points, which is great. We can quote you with points too, if you're going to recuperate those points in the amount of time you think you're going to stay in the home. And this is all part of that personalized prescription, so to speak, of your personal financial condition. A lot of online lenders also don't ask about if you're just, or the online calculators. So let's just talk about that for a second. Like those online calculators, great tool to help you start, but they're almost always wrong because you'll put in $500 a month for that auto loan that's going to be paid off in 6 months.
Yeah. Well, I have a whole episode that says mortgage calculators are garbage.
Great.
So I agree with you.
Episode.
And one of the biggest factors about those quotable rates that you get and just shopping rates, if you're working with a dedicated unicorn lender for months ahead of time, they've already saved you whatever you're getting quoted someplace else, even if they're both quoting 0 points, because they've shown you the different ways to potentially use a down payment assistance program. They've shown you the difference between a 20 and a 10. Well, let's do it. We were talking before, the episode started here about a specific example. You've got someone that has come into your mortgage place that they were referred to you by one of our homies who closed. So one of our homies got a house and their friend went, dude, who did you call? And so he went, call my unicorn lender. So this will help us figure out incomes. Let's talk about this.
Yes.
What did we say? This person's making $80,000 and we're going to figure out how much house they can buy?
Yep.
Okay,
so,
cool.
Yep. He's making about $80,000 a year. So divide that by 12. That's $6,667 a month. Okay. So we're going to take 45% of that 6660. I'm looking at my notes here. 6667. That gives
So
us,
we're taking 45%. Why?
Oh, yeah. Great question. So 45% of your gross monthly income is the standard most investors allow us to use for a debt to income ratio. 45% of your income can go to debt. What happens to the other 55%? Right? You want to know?
Yeah.
You want to know? The other 55%, we're accounting for your income tax.
Oh.
Your health benefits, or not.
All right.
Food, fuel, fun.
The 3 F's. I got it.
Yeah.
Okay.
You got to live a little.
Yeah.
45% is the general debt to income ratio. Every investor has higher or lower depending on all kinds of different things, credit scores, down payment amount, loan size. All of these things impact how high your debt to income ratio can go. In this initial discovery call, we are barely scratching the surface of your personal financial condition, and it's all verbal. None of it is vetted yet. It's all just a conversation. So we start with 45% debt to income ratio.
Okay.
Other 55% goes to everything we just talked about. That leaves $3,000 a month to go toward your new housing payment and anything that shows up on your credit report or your bank statements as a recurring payment. For example, auto loans, minimum payments on credit cards. If you have a personal loan, let's say it's a private loan from your parents that you pay them every month. We're going to see that on your bank statement. We want to know about it because it has to be calculated into your debt to income ratio because it's something you're repaying on a regular basis. All of this gets, go ahead, David.
I was going to say, so we're looking at the 6667, the devil plus 7, and we take 45% of that, and that's the $3,000.
Yes.
Okay. And so then is that $3,000 what we can use for our house payment?
Only if you have no debt. So if you have no debt, then you could $3,000. Let's go find you a house and you can afford up to $3,000 a month. And depending on how much money you have saved up for down payment, we're going to work backwards into a sales price. Of course, we've got interest rates that are fluctuating along the way too. So that's all going to be part of that matrix, so to speak, that we throw these numbers into. If you've got debt, then let's take those minimum monthly payments and take that off the $3,000.
Okay, so this guy's got $80,000.
Uh-huh.
He's got the 6667, which is the calculation, and then from that we calculate the $3,000.
Yep.
What was his debt?
He's got $400 a month in debt, a small auto loan, and a minimum credit card payment. Now he pays his credit cards off every month, but thankfully I don't have to use that in the debt to income ratio. Technically, he's only required to pay the minimum monthly payment.
Even so his minimum payment is $100 and he pays $500 every month.
Right. He pays it off.
Or whatever.
Every month.
Yeah. Okay.
So he has $400 a month that we have to calculate into his debt to income ratio. So that leaves $2,600 a month that could go towards his housing payment.
And where's that put him in today's, and if you're listening to this in the future, this is based on today's rates, right, Kelly?
Yep. So we're at 6.5% right now.
Cool.
Okay. And That might have changed in the middle of this because the market's so volatile right now.
Yeah, it might have changed. We're recording this. I don't know when it's going to go up. It could be 7.5. It could be 6.25 when you listen to this.
Truly.
But at 6.5.
At 6.5. So he's got 10% down. Plus he's got some gift money that's coming to him for his closing costs.
Oh, so cool.
Based on his 10% down in the market he's looking at, and of course, every market has different property taxes, you guys. So it's important that you understand what the average property taxes are in every area. Some are dirt cheap. Believe it or not, Hawaii is so cheap. So cheap. Property taxes are so cheap in Hawaii. And you want to go to certain areas in Chicago? Holy smokes. Illinois?
Yeah.
Crazy property tax. Texas, so expensive. But there's a trade-off with income tax too.
Yeah.
So anyway, I digress. So this particular client is buying in California, and he can
taxes aren't bad here.
1.25% across the entire state, give or take, depending on a lot of things. That's another podcast we could do. But $350,000 purchase price is what he qualifies for, because on
the $2,600. The monthly payment equals a $350,000 house
with 10% down. And
10% down, doesn't that mean he has a super expensive PMI though?
No.
How does he buy a house? How much is his PMI?
He's got great credit, by the way.
Okay.
He's got great credit, over 780, like great credit.
Okay.
And that does impact your PMI big time. If you've got a 620 credit score, your PMI, you're higher risk because you've proven on your credit report that, you've been having challenges, or maybe you've overextended yourself. Maybe there was a life incident. Maybe your dog got hit by a car and you had to max out all your credit cards. Like, that's real, you guys. It's real. And I'm not going to let my dog go either. I'm going to take care of my life. And that happens. So the PMI is going to be more expensive for the lower credit scores, but he's got great credit. His PMI is less than $45 a month. So
there you go, gang. I set her up for that one. Your PMI is only $45 a month, and at a $350,000 payment or $350,000 home, and with 10% down, then that means he only has to put $35,000 down, and any extra cash he has above and beyond that, once he covers his closing costs, it only costs him $44 a month or whatever it was, under $45. That's incredible. Okay, so break that down for me.
Yeah.
The guy makes $80,000.
He makes $80,000. So that's
$667 a month.
45% of that is $3,000 minus $400 a month for his auto loan, and his minimum payment on his credit card leaves us $2,600 a month that could go towards his principal and interest, the loan, principal and interest, his property taxes, which are annual, his homeowner's insurance. You got to be able to rebuild that thing if it burns to the ground. And by the way, you guys, insurance is going through its own metamorphosis right now. As soon as you see a house you could see yourself living in, call your insurance agent, ask them what it's going to cost you in insurance. Insurance is having to change. They're not used to doing that. They might give you pushback, push harder. Get the quote. It's important. It's part of your monthly payment. And it's also going to speak to your affordability. Because if that premium's higher than what we're estimating, and we always estimate high, because this industry is changing. Sorry, I digress.
No, this brings up the exact point that I've been doing forever. What's the difference between you going out and trying to get a quarter point here and you're shopping all these interest rates and you're looking at choosing your lender by a number? I'm telling you, choose a lender by their knowledge and their service. How many times has Kelly tangented today? I'm telling you, lenders, I get an email once a day. I get a phone call once a day. Dude, you talk to all the first-time home buyers. I'm a badass lender. No, I've taken 20 years to find the best. That type of service, that's unicorn.
It's important to understand the pitfalls that you don't know what you don't know when you haven't done this before. And that we call it words to the wise. You're wise enough to get into the housing market, right? And educate yourself. Like these words are for you, the wise. Here's what you need to do when you're out there shopping so you can make this offer and be fully empowered. If, let's say, they come back with a counter offer, but you really got to have the house and you're willing to pay more for it. If you haven't done the homework on your insurance and the insurance is double what you think it's going to be, all of a sudden you can't afford it, right? So it's just homework you got to do up front. It's just, anyway, thank you for that, David. Back to the payment.
Yeah.
Okay, back to the payment. The loan payment is about $1,991. The PMI, $44.63, right?
I don't even know why we're talking about it. It's so nothing.
Right? Versus another $35,000 to come up with 20% down. It's a lot easier to pay the $45 a month. Like, eat lunch at home for a week and you're good.
Yeah. You just loaned yourself $35,000 for $44 a month.
Cheapest money you'll ever buy, right? Like, that's a great point, right?
Yeah, you did.
Yeah, we threw $200 a month in here for homeowners insurance, which is on the high side for a $350,000 home. In this particular market, they might be able to get it for $1,200, but you're prepared.
Yeah.
Because if you end up buying in a flood zone, you need flood insurance too. The other part of the payment is property taxes. So 1.25% is $364 a month. All in, you're about $2,600 a month.
So we're looking at people go, I got to make six figures to buy a house. Well, okay, this guy's, what was it, 350 or 360 purchase?
350, 350.
350. So for $80,000, a $350,000 purchase price, and you're only putting 10% down. And that's just right now. That's just where the rates are at right now. And there could be down payment assistance programs. There could be potential gifts. There could be many different things that could change that to help make that more affordable for you. Most importantly, I don't think you guys understand out there. You can go online and fill something out and get some information. What Kelly and the Cort team do and what we've set up for you guys is, you see this interview we've had right now? You can have this with Kelly or someone from Kelly's team. If you reach out, you can have this type of phone call. And I'm telling you, I don't care. If you don't want to ask me for help, I don't need to be matchmaker to the whole world. My job is to make sure that everyone going through the first-time homebuyer process gets the right service. If you don't have a conversation like this in-depth and complete, then that person then you're just choosing someone who's not working at the highest level of service.
They're order takers, David. They're just order takers. Yeah. They're not guides. They're not advisors. They're not... anybody can crunch numbers. Everybody's got a calculator. But it's the pitfalls that we help you avoid and the words to the wise to help you feel fully empowered to escalate your purchase price. If there's a multiple counter offer and there's a bunch of buyers wanting to buy the same house, we give you all the ammo you need to feel completely confident. And we're just a phone call, text away.
And it's true. I've had so many people that have reached out, and then we set up one of these calls. They go through the discovery call. Every day I go in and I'm looking at a monthly update with someone who they went to their discovery call, and we got about 8 to 10 months of work, and some of them are 16 months. And every 30 days we check in to see how they're doing. The majority of the people that will come in after a conversation like this, imagine this podcast full with Kelly and you going through all these questions. Then you end up being one of those people that when I interview them after they close the home, they're like, oh my God, we didn't know. And we had all these things. And they ended up buying in, 3 weeks when they thought it was going to be 3 years. Mm-hmm. It's incredible.
Like our homie that had an offer letter.
Oh yeah.
Our homie that had an offer letter for employment. Everybody thinks you need 2 years of employment history. Not if you're going to school for the job you're about to get. And you've got somebody begging to hire you and willing to give you an offer letter. And your first payment, that like your start date is no more than 90 days after you move into your house, then we can use that income in most cases.
The offer letter, you have not even started. You could be in college, finishing your degree, interviewing, get the job, or you could be between jobs and you could have an offer letter for a new job that doesn't start for a little while. But as you have that offer letter in place, you can oftentimes... And in the case like we had, it's not about 2 years of employment. And that's that thing where you're punching it in and online. They're going to go, hey, are you working for 2 years?
Yeah.
So, gosh, we could do this. Well, we do this off air all the time.
We do.
We are consistently, well, I just want you homies to know what we're sitting around doing is consistently, it's why I started this whole thing. I'm like, if my sister was moving, and because she lives in Missouri and was trying to figure out where she wanted to live, like I would just talk to the people and make sure that they give this level of service. Anybody can help you buy a house, But to really save the most money, why not go and hire the best? Because unlike a lawyer where one guy makes $5,000 an hour and another guy makes $500 an hour, you can get the same high quality level of service from the best people, and you're not paying them, a crazy difference where people are like, oh, I'm the guy who charges this much. And when the way that we work is until you close on the property, then none of your professionals are getting paid.
Mm-mm.
So, we are working to eventually be paid through the purchase of the property, which means if you're doing 12 months or 15 months, you're not paying a monthly subscription. You're not paying every time that we pick up the phone or that we answer an email for you. And so why on earth would you not interview and choose the best people out there instead of just the first person at the top of Google?
Well, and you bring up a good point, David. You definitely want to do that interviewing of the lenders before you complete an application. Do your shopping first. See who's listening to you. See who's offering you guidance. See who's answering the questions you didn't know to ask. Because an order taker at an 800 number is not going to do that. They might offer you a lower interest rate, but they're not going to give you insights into what you can or could do if you chose to do XYZ or ABC. We're going to give you some options, give you insights of action steps you can take to get into the house you want versus the one you could qualify for today. Maybe you wait 3, 4, 5 months to get the house you want versus buying a condo today. So it's just, it's shopping up front before you complete an application is the best way to do your shopping. We've actually got a Word to the Wise document we're creating right now that is helping you ask certain questions of lenders that you're going to talk to in the shopping process. David teaches you to shop. It's important to shop. This is a huge investment, but the rate is, like you said, the rate is only one element of the shopping you're doing. You want somebody who's going to help you make a good decision. You're parting with your life savings in a lot of cases. You want an advisor, you want a partner, you want an advocate, you want somebody who feels it's a privilege to take care of you and to help guide you.
This is so typical of our conversations. Once again, I just got a piece of paper and wrote down something you said. You piss me off sometimes. 6 years of me doing this, I can't believe I've never said what you can do versus what you could do. Can versus could.
Yeah.
That's what you pay for. And you're not paying for it, gang. That's what I'm saying. It's like, if you're just shopping rates, I say options, but can versus could.
Yeah. The strategy is really, really important. And that's where the discovery call is truly a discovery for you as a homie, for us as your lending advisor and partner in you securing this awesome investment called real estate. We want to ask all the questions that are beneath the surface, things that could uncover opportunity, like a 401k loan. I bought my first house with a 401k. I had no money. The more money I made, the more money I spend. I like to spend. I'm a consumer. And there's a lot of you out there that are the same way. But I had, the more money I made, the more I qualified for too. But I didn't have the cash in my savings account. So somebody opened my eyes and said, well, do you have a 401k? Have you thought about taking a 401k loan? You guys, this is decades ago, like long time ago. And I'm like, what? No, don't I get taxed on that? Not if you take a 401k loan. You borrow from yourself. Now, if you leave your employer, you got to pay it back. And then that could cause all kinds of problems, which we could get into in your individual conversation and discovery call. But it's an option.
Now, as per usual with us in our conversation, we're going way long.
Yeah.
So rip through some of these things that are some of the differences. And I say differences, but it's just options. Like the adjustable rate mortgage and the 1-year temporary buy down and the speed to close and all that stuff. Again, these are the things that A, will make it easier, but B, also could be an option that will destroy whatever clickbait rate you're seeing.
Mm-hmm. Yeah. So and I mentioned it earlier, the Words to the Wise that we're putting together to help you shop lenders. We're giving you the questions to ask. But a couple of the things that aren't always talked about in initial discovery calls are adjustable rate mortgages versus fixed rate mortgages. And right now, adjustable rate mortgages are not attractive at all. Some lenders, although that was a couple of days ago, things could be different today. Some lenders see when the rates start trending down, adjustable rate mortgages come back as a good option. When rates start to have these little knee-jerk hikes because of an irrational response to a political member's commentary, it's humans pushing buttons, trading billions of dollars in stocks and bonds every day. So that's what drives these erratic movements. But adjustable rate mortgages are loans that allow you to have an interest rate that's fixed for 5, 7, or 10 years. Because your first house, you're probably not going to be there in 7 years. So why do you need a 30-year fixed rate? You really only need that rate fixed for 7 years. The payment's still based on 30 years, but the rate's only fixed for 7 years. So if you know for a fact you're going to move, maybe you've got a job transfer coming up, especially military folks, they're relocating all the time. Maybe an adjustable rate mortgage at the certain time in the market is a good option. Today's not a good option. 3 days ago was a good option.
And see, that's the difference. And that's what the discussions at the beginning. So it's the same thing with the temporary buy down. It's kind of like you were talking about points earlier. So you have to do the formula, right?
Yeah. A temporary buy down buys down your interest rate. So Guild Mortgage offers a 1% 1 year lender paid interest rate buy down.
What?
Yeah. So we're talking about 6.5% with this other example, right? We'll buy that rate down to 5.5% for the first year.
Wait, the lender pays for that?
Yeah. But.
Yeah.
It's actually not a 6.5 down to 5.5% because that 1 year lender paid buy down is going to hike up that final rate. So let's say instead of 6.5, which we're offering out the gate, if you want that lower rate the first year
for zero.
Yeah.
So you're getting 6.5 for zero.
Yes.
So then what you're going to do is you're going to bump it up.
Yes. It's like a teaser.
Okay.
It's like a teaser.
Yeah.
So you're going to save more money for the first year, but you're going to pay more for the next 29.
Got it.
And that's what these lender paid 1% 1 year buy downs are. It's a little, it looks sexy. It looks exciting for the first year because we're going to buy your rate down, with a 5 in front of the decimal point or a 6.1 or something like that. But then for the next 29 years, you're at 7 point something.
Wow.
Yes.
So somebody else is going to go out and sell that to people as we buy down your rate to 5.5, and where you could be like, hey, 6.5 for 30 years is going to be a better deal for you. Or they're that military person who's like, I'm going to move in 2 years. And you're like, sweet, let's drop you down.
Yeah, exactly. So it's, again, individual prescription, so to speak.
Yep.
Yeah.
Yep.
Speed to close is a big deal right now. Sellers, especially the sellers listing right now, they need to move. And the less risk that you represent as a buyer, the more attractive your offer is. If you're coming in being able to close in 15 days and you're offering $350,000 for a home and somebody else needs 60 days and they're offering 360, but the seller needs to move now, you're more attractive. So speed to close is definitely a benefit of the lender relationship. And give us enough time. Give us a couple of weeks to get you through underwriting so that you can write an offer fully approved and you'll be able to close in 15 days in most cases.
Okay, rip through the rest of these. Yep. And if you guys have questions about what she goes through real quick here, howtobuyhome.com and ask me, but I want to go through these other things.
Okay. Weekend and evening availability. The online lenders, big banks, they post sexy rates, but they're probably not going to answer your text when you're trying to figure out whether you can increase your sales price by $5,000 at 7 p.m. at night or on a Sunday when offers are being reviewed at 9 a.m. tomorrow morning. Our team, this is a big deal. We know what you're going through. We're your partner in it. Weekend and evening availability. Upfront underwriting, very few lenders are going to get you approved to be able to close in 15 days. It costs us money to put you through underwriting. We are investing in you because we know that's what you need to write a super competitive offer and close quickly. Accurate and lockable rate quotes. A lot of lenders will give you an interest rate quote, and then all of a sudden you go to ask for the rate and it's gone magically. It's
Yep.
called bait and switch. So also know that rate and APR transparency is really important. Interest rate is just one of the numbers that you need to pay attention to. If it's a high cost loan, there's going to be an interest rate and an APR, annual percentage rate. The annual percentage rate speaks to the total closing costs that add on to your interest rate to give you an effective percentage of the cost of this loan for 30 years. We can dive more into that on your discovery call. Loan servicing after closing, over 90% of our loans are kept in our servicing portfolio. So you close with Guild, you make your payments to Guild, you call us if you have questions about your statement that came in or your escrow disbursement. We're your point of contact. So loan servicing after closing is something a lot of lenders do not offer. We do at Guild. Future refinance options. We have some opportunities if the rates drop. We, under certain loan programs, we'll waive your lender fees. So any fees that we would otherwise charge, you're not going to pay them again when you go to refinance if you refinance with us and you close with us. So those are some of the differences.
And homies, the reason why I've had Kelly on one other time with a unicorn agent, and they kind of walked us through the process. But the reason why I'm telling you all the time, get out there, find your local unicorn, and then find your unicorn lender through them, is because when lenders come on to sell or try to do this at the national level, they're not working with the high level of service. And that's the reason why she's the only one. I'm trying to let you guys understand everything that she's listed through. The weekend availability, you absolutely 100% have to have that. And that's a great thing. When I work with them, I know, they have like an on-call system. There's always somebody on call every weekend. And locking your rates, the annual percentage, which is basically the fees you pay for the loan, that's a huge thing. The fact is it doesn't get sold. So many people talk to me about that. And the refinancing. Now, all these things are things that you're not going to have in your initial discussion with a lender that you find online. So I am begging you, I am pleading to you, just like from the very beginning, I said, look, I'm going to throw all this information out into the universe. You take with it and do what you want. The tens of thousands, if not hundreds of thousands of dollars that you're going to save when you get this level of service, if you do not feel like the people that you are talking to, both the realtor and the lender, couldn't have the banter and the discussion that Kelly and I just had for the last hour, then you're getting a lower level of service and you have no reason. It's not because you can't afford that level of service. It's all out there for every buyer to grab. So, Kelly, I want to thank you once again so much. This has been so valuable. We could have done 4 hours on this. If you guys have more questions about any of this stuff, hit me up. Kelly, any words of wisdom for the homies? I'm going to put you on the spot.
Yeah.
I'm going to make you do the perfect ending. Go.
Yeah, I just say empower yourselves, you guys, and reach out to David. He'll connect you to the right folks to help you build a plan. Just because you think you're not ready doesn't mean that you couldn't be ready. And we'll let you know when you are ready. And just because you can doesn't mean that you should either, because you could do XYZ if we know all the pieces of the puzzle. So let us help you create a plan. David has been at this educating first-time home buyers for years now, and I admire you so much, David. Thank you so much for having me as a guest. And homie on, man. Unicorn on. I love your shirt, dude.
Thank you. I know I had to wear it today. I think because I knew you were coming. This has been a phenomenal piece, and I will just reiterate this one more time. When you call a lender, anyone who goes through Kelly and anyone who goes through the other unicorn lenders that will work with some of our agents out there, this is the first phone call. If you're not getting this level of detail and information, then you're getting a lower level of service, and there's no reason you should. So this is my public service announcement to everybody. And if you decide you don't want to reach out to me, you better be getting this level of service. That's all I'm saying. Thanks so much, everybody. I will talk to you later. Well, that was freaking awesome. And hey, if you're new around here, I hope these past 2 episodes make you feel more confident about the lending portion of your home buying process. But I realize you probably have some more questions. So here's what you do. Start with the 10 basic steps to buying a home. Begins at episode 301. These are not generic tips. They help you build a custom plan based on your real life. And if you want proof it works, look for the listener stories in the feed of all the podcasts. They're marked interview. They're real people just like you who crushed their goals, and they walk you through the exact steps they took to get there. And you need a crash course in the real estate lingo? Well, the Real Estate Turns A to Z started at episode 94. And hey, you don't need to listen to every episode. Just scroll through the titles for what applies to you today in your journey. And if you're not sure where to start, hit Ask David at howtobuyahome.com, and I'll point you to the exact episode or the resources that you need. It's all free. That's what we do here. Now, I'm not going to recap the highlights of part 2 of Kelly's interview with me. I'm instead going to encourage you to go back and re-listen to episode 1 and episode 2 here to boost your confidence in the lending process. It always helps to hear it directly from a seasoned pro, someone who's working in the trenches every day to give the confused people clarity and ultimately success. My biggest takeaway from the entire conversation, it's a discovery call, not a pre-approval process. So set up your discovery call now. It's a discovery call, not a pre-approval process. It's so much more than that. It's a plan. And if your lender hasn't already asked you the questions that Kelly asked here, unfortunately, you're probably flying blind. Don't wait until you think that you're ready. You could already qualify or be just a few smart moves away. Like I said, you can always go to howtobuyahome.com and we'll connect you with the unicorn lender and realtor who won't just get you pre-approved, they'll help you win the house. I've been doing this 20 years and I talk to different lenders all over the country. And I'm telling you, if the people aren't talking to you the way that Kelly does, well, then they're not a unicorn, period. And that is the level of service that you deserve. It's not about who answers the phone. It's about who knows how to win the deal and get you the best long-term result. You can do this.
Looking for more DIY education or your own personal step-by-step guidance through the home buying journey? Since 2019, How to Buy a Home has been the #1 resource for first-time home buyers. So visit howtobuyahome.com to get started.